Well, hi everyone, and welcome to Buffett and Beyond Research Stock of the Week. And the big question is, would you rather have Arthur Gallagher, AJG, or Blackrock in your portfolio? And folks, we're going to answer that question right here and show you the proof. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at these two companies. Well, they're both in the financial services business, and Arthur J. Gallagher and Company provides insurance, brokerage, risk management, employee benefit services to a wide variety of commercial, industrial, institutional, governmental organizations, and 250 offices in 7 countries. Now, Blackrock is one of the world's largest publicly traded investment management firms and manages assets on behalf of institutions and individuals worldwide. And these definitions go on, but you can see they're similar companies in one way, in that they're in the financial services business. So let us look at the numbers of these companies. And the first thing we want to look at, and of course over here is the year. So looking at Blackrock up here, and we're looking at AJG, and we'll call it Arthur Gallagher because AJG is difficult to keep saying all the time. And the first thing we look at is the clean surplus return on equity. Now, this return on equity is different than the traditional accounting return on equity. But think of your bank account. Would you rather put your money in a stock that is giving you 20% a year? Yeah, I would. Or would you rather put your money in a company that's giving you 24% a year? Well, even better. So we're looking at the average stock in the S&P 500 has about a 13.5% clean surplus return on equity. So the theory of clean surplus is that stocks with higher clean surplus return on equity will outperform stocks with lower clean surplus ROEs. And if you divide the investment stocks into 2 groups, one that the first group has a higher return on equity than the average stock, higher than 13.5%, you'll outperform the S&P 500. If you have stocks in your portfolio that have lower than 13.5% return on equity, you'll underperform the S&P 500. And I'll tell you, we've done a lot of analysis of portfolios out there when we had our radio program for several years, which was very, very successful. Folks, you all had good stocks in your portfolio. The problem is you all had stocks that were below average stocks in your portfolio. And I mean, that was almost to a portfolio, to a T. You all had good stocks and you all had stocks that, gee, we grew up with and they sounded good and they've been good to us, but they're not as good as the average stock any longer. So that's what you have to look at. You have to be able to look at the clean surplus return on equity. That's why we have a computer program that does this for us. So we're looking at AJG, Arthur Gallagher, and we would think that this stock will outperform the S&P 500 and will outperform Blackrock over time. Now, let's go over here to retention rate. Retention rate is how much of the money a company is making is it putting back in, is it retaining and putting it back into itself in order to grow. Blackrock with about a 50%, 51%, and Arthur Gallagher with 59%. So Arthur Gallagher seems to be, not seems, but is putting more of what it makes back into itself in order to grow. Now, let's come all the way over here for a minute and realize one thing. The market cap of Blackrock is double that of AJG. So therefore, Blackrock is a larger company. So if it's putting 50% of its money it's making back into the company, it's still putting more money into itself than is Arthur Gallagher. But Arthur Gallagher has room to grow. And how do we know that it's using its money efficiently in order to grow? We go back to the clean surplus return on equity, a high clean surplus return on equity, and it's putting money back into itself in order to grow, and it's investing it at or reinvesting it at a nice high return on equity. And that's what we look at. All right, let's go to net income growth. And net income growth is the income. It's not traditional accounting earnings. It is clean surplus earnings. It's the earnings from the core operations of the business. Think about McDonald's. Is McDonald's a burger place or is it a real estate company? Because it owns a lot of real estate, folks. So if it sells off some of the real estate to its franchisees and that goes on the income statement, that shows up as profit. But really, when we compare McDonald's, we compare it to Wendy's, we compare it to Burger King. So we want to know the real income from the core operations of the company. And we can see that Arthur Gallagher is double that of Blackrock, so its net income growth is double Blackrock. So that's very, very good. And the average stock out there is about maybe 13% net income growth for 2025. So Arthur Gallagher is an above average company in this stage or in this area where BlackRock is not, if it's underperforming. Revenue growth about 7% for the average stock out there. So BlackRock is a little bit over the average stock, which is good. And Arthur Gallagher at 9.2% is about 20% better than the average stock out there. So that's even better than BlackRock. Now, years to pay debt. This is Buffett's rule of thumb. He says if a company takes all the money that it's making and uses it just to pay off the debt, how many years would it take to pay off its debt? His rule of thumb is 5 or less. Ours is 3 or less, so BlackRock certainly fits the bill there. But when we get down to Gallagher, we're looking at 5 years to pay debt. That's within Buffett's parameters, not ours so much. But when we look at the revenue growth and we look at the net income growth above average and we look at this return on equity, if we're going to have one of these two stocks, we would probably go with Arthur Gallagher. In fact, we have. Okay, so let's look at the 1 year return of the S&P 500, which is in the black line, and Arthur Gallagher, which is this mustard colored line, and then BlackRock, which is the blue line. Now, of course, as I'm recording this, we are having a difficult time in the market because of all the tariff news going on and the political back and forth that's happening in Congress. But anyway, the market has been having a tough time, and BlackRock has come down with the market. You can see the black line is the market, and you can see how far down it's come, and BlackRock has gone down with it. But Arthur Gallagher, which we predict would outperform BlackRock because it has a higher clean surplus ROE and is also in our portfolio because we look at it as a defensive stock. And as we look at this line, the blue line coming down, black line coming down, which is the market, blue line again coming down, which is BlackRock, and we see Arthur Gallagher during this time of turmoil is actually going up. So that's the kind of stock we like, folks, a growth stock that is going up when the market is going down. You can't beat that kind of return. Now let's look at 5 years to see if it's really a growth stock. And here we are at 5 years. Black line is the S&P 500. Again, remember, blue line is BlackRock, and you can see right in here, and this is this year of 2025, the market is going down. It peaked in February. So this is February right here. And both the market and BlackRock are going down together while Arthur Gallagher is going up for the year. And you can see that over 5 years with the market up about 75%, BlackRock up about 75%. This is over 5 years. And Arthur Gallagher up about 275%. So again, 75-80% for the market and BlackRock, and 275%. Big difference for Arthur Gallagher. So yeah, we just love this stock. And before, when we went over what these stocks do, remember Arthur Gallagher is also in insurance, where BlackRock is not. BlackRock is more of a money manager, where Arthur Gallagher is an all-around financial company. Speaking of finance, let's look at the finance ETF and see how it has performed relative to these two stocks, because both of them are in the finance ETF. So when we look at the finance ETF, which is this red line, you can see the finance ETF follows the S&P 500. BlackRock follows both of them, but look at Arthur Gallagher way up here at this 275% return. So would you rather buy the ETF from the finance industry and say, hey, I have stocks across all areas in the finance industry? The answer is no, because again, back to the beginning of this lesson, well, every ETF has the best stocks in that ETF, and it has the below average stocks in that ETF. So what Clean Surplus does differentiate between the better performing stocks, and we do that with the higher Clean Surplus ROE. Think of your bank. If you go to the bank that has a 26% return or a bank that has a 20% return. So yeah, you want to go with the bank that's giving you the higher Clean Surplus return on equity, because the Clean Surplus return on equity is comparable. So folks, yeah, Arthur Gallagher is our stock for sure. And we can even see back in 2022, right in here, where the market went down, the finance ETF went down, BlackRock went down about 19.6% for the S&P 500, the decline in 2022. And look at Arthur Gallagher, went up in 2022. And now with this next decline that we're having, we see Arthur Gallagher going up while the market is going down, the ETF is going down, and BlackRock is going down. So folks, yeah, Arthur Gallagher is in our growth portfolio, and it's our pick. We like it, especially when the market goes down. So folks, we had a tumultuous week this week, really, really crazy, with the market having the best day since 2008, but yet the day before it had the worst day in a long time. So the market is all over the place. So go out this weekend, clear your head, be with your family, be with your loved ones, stay safe. And folks, guess what? We'll see you right back here in a couple of days.